Welcome back to the channel, folks. After the whirlwind caused by the Fed announcement yesterday, we're here to focus on resilient swing trade setups that could make your portfolio shine. Today is December 19th, and I'm recording this right during trading hours, so you're getting an up-to-the-minute analysis. Before we dive into the stocks, let's take a moment to assess the broader market sentiment. The Nasdaq Composite is up 0.28%, though it's down 0.7% from the day's opening. Similarly, the S&P 500 is up 0.27%, but it has slipped 0.67% intraday. Finally, the Dow Jones shows a 0.3% gain, but like the others, it has fallen 0.7% from its open. What does this tell us? The market seems to be in recovery mode, attempting to shake off the turbulence caused by yesterday's news. But, with those intraday losses, it's clear investors are still treading cautiously. Before we jump into the stock analysis, keep this in mind. The focus here is on short-term swing trades. These setups are rooted in technical chart patterns with just a sprinkle of fundamentals for perspective. This is not investment advice. The goal is to help you spot opportunities based on sound technical principles, not speculation. First up, US Bancorp, ticker USB. Let's start with US Bancorp, a stalwart in the financial sector. This is a large-cap stock with a market valuation of $74 billion. The company is a leader in banking and financial services, offering products like loans, deposits, and investment management across the United States. Now, onto the numbers. US Bancorp generated an impressive income of $5 billion from $41 billion in sales, translating to a profit margin of 12%, a solid performance for a financial heavyweight. The stock boasts a PE ratio of 15, with earnings per share at $3.27. Plus, it offers a dividend yield of 4.12%, making it a favorite among income-focused investors. Here's where it gets exciting. Let's talk about the chart setup for US Bancorp. This stock has been in a strong uptrend since June 11th, with a rising trend line connecting its higher lows. Think of this trend line as a springboard, giving the stock momentum for its next move. Currently, the stock is trading just about 1% above this trendline support. Why does this matter? Because if the stock finds support here, it could rally toward its recent highs, offering a 12% upside. On the flip side, if the trendline doesn't hold, the downside risk is limited to about 1%, a favorable risk-to-reward ratio of 1 to 12 for long-side traders. But wait, there's more. If the support breaks, the stock could shift gears entirely and become a top short-selling candidate. Oh, and here's a little nugget. This type of setup is what swing traders dream of: tight downside risk with room for explosive upside. Keep the stock on your watch list and monitor its movement around the trend line. This could be a textbook opportunity for both long and short trades. Next, let's turn to Shake Shack, a company from the consumer cyclical sector. This is a mid-cap stock valued at $5 billion. Known for its delicious burgers, hot dogs, and shakes, Shake Shack operates fast casual restaurants across the United States and internationally. The financials here are more nuanced. Shake Shack generated sales of $1.2 billion, resulting in an income of $8 million, with a profit margin of 0.68%. Its PE ratio is an eye-popping 696, meaning the stock's valuation heavily relies on future growth expectations. Now let's sink our teeth into Shake Shack's chart setup. The stock has been in an uptrend since July 25th, and its rising trend line, formed by connecting its higher lows, acts as a key support level. Currently, the stock is trading 2% above this trendline support. Here's why this is crucial. If the stock respects this support, it could initiate a short-term rally, targeting its recent highs for a 10% upside. The downside risk, limited to just 2% if the trend line fails to hold. That sets up a risk-to-reward ratio of 1 to 5, which is quite appealing for a swing trade. But there's a twist. If the stock breaks below the trend line, it becomes a prime short-selling candidate. For traders, this means you'll want to keep a sharp eye on its movement around this critical level. It's the battleground where bulls and bears will clash. No hype here, just real talk based on what the charts actually show. Keep this stock on your radar. It's poised for action, one way or the other. Up next is Cardinal Health, a company in the healthcare sector. This is a large cap stock valued at an impressive $28 billion. Cardinal Health provides healthcare services and products, including pharmaceuticals, medical supplies, and solutions that streamline the supply chain for hospitals, clinics, and other healthcare providers. Financially, the company delivered sales of $224 billion, resulting in an income of $1 billion, with a profit margin of 0.56%. The stock trades at a PE ratio of 23, with earnings per share at $5.15. Investors also enjoy a dividend yield of 1.73%, a nice bonus for holding this stock. Let's dive into Cardinal Health's chart setup. The stock began an uptrend on July 15th, forming a clear rising trend line by connecting its higher lows. As we've seen with similar setups, this trend line serves as a strong support zone for price movements. Currently, the stock is trading 3% above this trendline support. If this support holds, the stock has the potential to rally and retest its recent highs, offering a 9% upside. On the downside, if the trendline breaks, the risk is limited to about 3%, making this a risk-to-reward ratio of 1 to 3, an attractive setup for swing traders. Now here's the kicker. If the trendline fails, the stock could become a strong candidate for short selling. For now, traders should monitor how the price behaves around this support level. Is the stock ready to bounce, or will the bears take over? Guys, I'm not here to promise skyrocketing returns. No one can. My focus is to help you spot stocks at key levels that, based on technical analysis, have a solid chance of making a move. The final stock on today's list is DraftKings, part of the consumer cyclical sector. This is a large cap stock valued at $34 billion. DraftKings is a leader in digital sports entertainment, offering online sports betting, iGaming, daily fantasy sports, and more, primarily operating in the United States. The financials tell an interesting story. DraftKings generated sales of $4 billion, though it reported a loss of $417 million, translating to a negative profit margin of 9%. The EPS is negative at $0.87, and the stock does not currently offer a dividend. Now let's break down DraftKings' chart setup. Since August 5th, the stock has been in a steady uptrend, forming a rising trend line. This trend line has acted as a reliable support, helping the stock establish higher lows and maintain bullish momentum. At the moment, the stock is trading just 1% above this trend line support. If the price holds here, there's significant potential for a short-term rally, possibly retesting its recent highs for an 18% upside. The downside, a limited 1% risk if the trend line breaks. This creates a highly favorable risk-to-reward ratio of 1 to 18, a dream scenario for technical traders. But here's where things get interesting. If the trend line doesn't hold, the stock could flip to being a prime short-selling candidate. This is why DraftKings should stay on your radar. It's a critical level for the stock, and whichever way it moves, it could offer oh-so-attractive trading opportunities. And that wraps up today's video, folks. We've covered 4 potential swing trade setups, each with well-defined risk and reward scenarios. Remember, the goal isn't just to spot opportunities. It's to act with discipline and stick to your trading plan. If you found value in this analysis, make sure to hit that subscribe button and turn on notifications so you don't miss our next upload. Oh, and don't forget to leave a like and share this video with fellow traders who could use a no-nonsense approach to stock trading. Until next time, stay sharp, trade smart, and I'll see you in the next video.